Hello everybody and welcome to BetaShares webinar for today. We're really excited to be talking about ethical and sustainable investing. We're going to get started in just a couple of minutes, so if you please stay tuned, we will be with you shortly. Hello everybody and welcome once again to the BetaShares webinar for today. I'm really excited today to talk about, have with me two panelists who will talk about the rise of ethical investing in Australia, a topic that certainly seems to be top of mind for many investors and is a very fast growing area both within our business and in general in the industry and more generally. Before we get started, just some important information for you to read. Anything we talk about here today will be considered general advice only. We have not taken into account anyone's personal circumstances at all in relating this information. And if you do have any interest in any of the products we talk about today, please do consult your financial advisor and please do read our product disclosure statement or PDS. A little bit of housekeeping to start. A recording of the session will be sent to all attendees and all registered attendees, even if one does not attend. There is a little widget you have in front of you where you are reviewing and viewing this webinar. If you have a question, please do type it in and we'll endeavour to answer those questions either during the presentation or at the end of it. And with that, I will just introduce our two esteemed presenters. Leading the presentation today will be Nathan Lim. He's the head of wealth management research at Morgan Stanley and a foremost expert authority on sustainable and ethical investing. He's had a number of years of experience, 20 years of experience in asset management, and has also spent time at Australian Ethical, where he was involved as a portfolio manager in the Australian Ethical Fund. And I'm furthermore joined by Adam O'Connor. He's a manager at distribution and capital markets who works with us here at BetaShares. Adam is involved with supporting the institutional, intermediary, broker and advisor channels and has a particular interest in ethical, sustainable investing. Today, we're going to talk about the rise of ethical investing, investing with impact, what's happening in the industry, what is happening in the world of ethical investing, and what does it mean when we talk about true to label ethical investing? Is there such a thing? Does it actually exist? How does one access ethical investing? We'll spend a little bit of time talking about BetaShares' own decision to remove Facebook from our Global Ethical Fund or Global Sustainable Leaders Fund. And then Adam will wrap up with an actual description of those funds for those who have interest in the particular topic. Now, before I turn over to Nathan, I'm just going to ask a quick live question of the audience. So please fill in your form and answer the question here, which is essentially, what are your motivations for choosing ethical investing? So you can click more than one. So to support ethical and sustainable business practices, performance, access, diversification, or I'm not currently invested in an ethical fund. I'll just let those answers get collated and then I'll show you the responses to those. So you can see there that, unsurprisingly, most people have clicked on to support ethical and sustainable business practices, but also performance at 30%, and diversification, which we'll definitely have a discussion about later in the presentation. Interestingly, 35% of you not currently invested in an ethical fund. So that's an interesting one. And finally, just one more poll for the audience. Just where would you consider making an ethical investment? Australian shares, global shares, both or none? Let that come through. And unsurprisingly, of course, the vast majority of you would consider a ethical investment in both Australian and global shares. And interestingly, of those who do choose just one, it seems to be global shares, which wins out, although it's obviously a far smaller percentage. So yeah, some interesting responses there. Thank you for that. And with that, I will now hand over to Nathan, who will take us through investing with impact. Nathan, over to you.
Thank you very much. And thanks everyone for taking the time today to listen in. And what I'm going to do right now is sort of just introduce a few concepts to you. But let's just roll forward to the first slide. And the first one I want to sort of introduce everybody into is this idea of like, what do you want to do with your capital? I think many of us who would go and get a coffee in the morning would bring our keep cup, or when we go grocery shopping, we will bring recycling bags. And individually, what we're doing there is we're making a conscious decision to do something positive for the environment, and there's nothing wrong with that. And it's actually something I wish more people would do. But then when you take a step back and you look at your broader impact and you start thinking about your capital, you start thinking about your finances, are you doing the same thing with your savings, with your superannuation, which would also have a far greater impact on affecting the world that we live in? And so with that sort of background, it was back in 2012 that Morgan Stanley launched an initiative called Investing with Impact, where we tried to generate market rate financial returns while demonstrating positive environmental and social impacts. Effectively, what we're trying to do is help bring alignment between an individual or an organization's values and their investment objectives. You have to understand that there is an inherent mismatch between stakeholders if your organization, for example, is working against substance abuse while simultaneously investing your surplus capital in alcohol retailing or gambling. So for the balance of today's presentation, what I'm going to do is I'm going to talk to some market statistics about responsible investing here in Australia, some myths, some very common myths that we see about responsible investing, and also, lastly, what I think is probably the most important thing from an educational perspective, the importance of language when talking about responsible investing. So with that, we're going to flip the page. And so here's some broad market statistics that we've been able to pull together. The first one, 75%, that really speaks to the fact that the market or fund managers are responding to demands from their clients and are now creating sustainable products for their clients. 86%, that speaks to millennials. We know that the next generation of wealth is very much interested in learning more and investing in a way that's consistent with their values. And that 71%, that just speaks to investors more broadly, in the sense that investors, people like you and I, we intuitively know that it's very often the non-financial factors, or those things that are not listed in the profit and loss statement, or those things that are not listed in the balance sheet, that are actually the most important things to consider when you're investing in a company. Good example I like to use is, say, a mining company. So let's say this mining company uses a lot of water, which most mining companies do. And that water is shared with a local town. Now, what would happen one day if there was a drought? I think it's fair to say that the mining company is not going to be able to keep taking water for its operation at the expense of the thirsty locals next door. This is not something that appears in any financial statement. It never says in there water scarcity is something to consider, but that is something that you can clearly see from an ESG perspective as being material to the operations of the business. So with that, flipping the slide now, I'm going to talk about some of the myths that we see in the market. The first one, of course, is that investing with impact or responsible investing, it's a niche area. You know what? It's something that it's not really well talked about. Nobody really does it. But it turns out, let's first of all, looking at the US as an example, basically 1 out of every $5 is under professional management is invested in a sustainable fashion. The current market in the US for sustainable investments is $8.7 trillion. Another interesting fact is that when you look at those charts more carefully, you see that from 1995 to 2012, the market basically grew at a very healthy rate of around 11% a year. However, from 2012, you can see that there was a sudden, very dramatic acceleration such that the annualized rate of growth is now running at 24%. Just in the last couple of years, you've seen a doubling in the growth rate. Flipping the page now and looking at in Australia, the experience here has been very similar. Now, I'd like to first of all refer to the numbers at RIA, or the Responsible Investment Association for Australasia. There's two numbers. Let's take a step back for a moment. There's two numbers that people frequently quote from RIA. The first one is sort of their broad responsible investment number for Australasia at $622 billion, or 44% of all assets professionally managed are managed in a responsible manner. I admittedly find that definition a bit broad and prefer to cite the more narrowly defined universe of core strategies. And by core strategies, it means it must have at least one of the following. It must screen investments, have sustainably themed investing, impact or community investing, and or corporate engagement and shareholder action. When you look at the core number, the size of the market today in Australia is around $64.9 billion. But again, what I find more interesting is looking at how that fund growth has moved over time. So in the 10 years before 2012, responsible investing assets under management were growing at a very modest 3% a year. However, just like in the US, something clicked in 2012 such that you've seen a rapid take-up of responsible investment choices such that the growth rate is now annualizing at 41%. A 3 to 41 is by definition an inflection point. And I'll preempt anybody who wants to ask the question, because I've got it a few times, what happened in 2012? To be quite honest with you, we don't have a strong answer. For some collective reason, the market suddenly just woke up to this way of investing. Flipping the page now, these are the broader numbers that are usually cited by RIA, and you can see there that $622 billion versus the $64.9 billion. The key number I want to call out here is really where we're seeing the fastest growth, and that is clearly happening with core responsible investing options at 26% year over year. Flipping the page, another big myth that we come into is that there isn't much choice for investors. Now, admittedly, back in 2012, I think that would have been a very fair characterization. Back in 2012, there was merely 21 firms offering a range of products and representing around $16 billion of responsible investing funds. Today, we're now at 75 managers with 224 products. So clearly, there has been a substantial maturing and availability of product in the market just in a very short period of time. Turning the page now, just very briefly, this is the framework that Morgan Stanley uses when we talk about responsible investing or investing with impact. And I think this really gets to the heart of one of the key messages that I want to deliver today, and this is really around the concept of language. A lot of investors or a lot of market commentators use words like ethical or environmental social governance or impact like they all mean the same thing. And the analogy I would use is if we were talking about Commonwealth Bank and Telstra and Harvey Norman, but instead of referring to them by the company names, we just simply refer to them as shares, you would see very quickly how that becomes quite nonsensical. And I think it's very important from an educational perspective and also as practitioners that we all must be very careful with the words that we use to describe what we're doing. So what we're seeing here on the screen right now is Morgan Stanley's framework. And the way that we basically segment the market is we break it down into 4 distinct market segments, and we segment them by their impact strategy. First, of course, is restrictive screening. And this is most closely associated with ethical investing or negative screening. And this is really where responsible investing began, and is today actually where responsible investors are returning. It's my personal view that the market has sort of gone full circle, that there was a time when responsible investing was all about negative screening. then it had evolved into more nuanced approaches, but in the fullness of time, I think people are starting to come back to first principles, and you're seeing a renaissance in negative screening products again. The second category is, of course, ESG integration, or environmental, social, and governance integration. What we're speaking about here is what we referenced earlier, is this idea that you're looking at non-financial factors as helping complete a full or more how do you say, holistic picture of a company that goes just beyond the financials. One of my personal favorite things to do is to look at a company's lost time injury report. For those of you who aren't familiar with the lost time injury report, it's typically found at the back of most of all annual reports, and it basically reports on the number of accidents and unfortunately fatalities that the company experienced over the last 12 months. What I find quite interesting is that if you have a company that can't even bring its own staff home safely every day, what hope do you have as a customer or as a supplier to such a firm? It also ties back to what I was saying earlier around the fact that many of the things that you look at in a company are often non-financial. Safety is one. Water scarcity is another. There's many other non-financial factors that should be considered when you're looking at a company, and that's what ESG integration is all about. It can also incorporate an element of restrictive screening, but clearly the focus is on non-financial factors. The third impact strategy that we look at is thematic exposures. And this is really about investors who are trying to target specific issues like climate change or sugar, or trying to avoid sugar, or water scarcity. The key thing here is that these sort of investments go beyond just trying to avoid the bad, but are trying to invest in the good simultaneously. So for example, if I had a fund that was solely seeking to avoid investing in fossil fuels, that would be really falling more into the restrictive screening bucket. However, if that same strategy was not only in avoiding investing in thermal coal, but was simultaneously supporting renewables or energy efficiency, then clearly that would fall under the thematic basket. And lastly, of course, the fourth impact strategy that we talk to is impact investing. And the way I like to think of this group is that it's philanthropy with hurdles. It's really more directed towards the private markets as opposed to the public markets, so away from the share markets, but more towards private equity. And it aims to deliver very specific positive social or environmental impacts, like financing community housing or rural solar power schemes or the like. All right, so turning the page now, looking at myth, the primary myth that most people sort of carry in their back pocket is that clearly investing with impact or responsible investing means sacrificing returns. Now, first and foremost, that is just completely false. And the first thing we're going to point you to is let's look at the US experience, because that's where we've got the longest time series. So what we've got on the charts right now is the MSCI KLD Social Index that goes back to 1990. The index has got 400 companies which meet high environmental, social, and governance standards. And what this chart clearly shows is that there's absolutely no penalty, but actually outperformance against the conventional S&P 500 index. And yes, this does include dividends on both measures. Turning the page, we can then see that Morgan Stanley, what we've done is we did our own study of the entire equity fund management industry in the US, and we concluded that 64% of the funds that invested sustainably had the same or better returns than traditional funds, and this is the most important part, and simultaneously had the same or lower volatility. Basically what we're saying is that you get the same return for lower risk. Now that's a pretty good outcome regardless of what type of investor you are. And then lastly, just looking at the experience here in Australia, again, I like to call out the numbers from the Responsible Investment Association of Australasia. What we can show here is you're looking at the very top there that the average Australian responsible investment shares fund versus the ASX 300 has outperformed on a 3, 5, and 10-year basis, which I believe is very strong evidence of persistent outperformance. In fact, when you sort of step back and look at these numbers more broadly, I'm not going to sit here and say to you that responsible investing is always going to outperform, but clearly an approach grounded in responsible investing principles will provide competitive market returns. So look, that's my few minutes and my sort of introductory comments about responsible investing here in Australia. And with that, I'm going to roll it over to Adam.
Oh, brilliant. Thanks, Nathan. Look, Nathan's given us a pretty excellent summary there of what investing with impact means in the Australian market, and it's an investment area that I've taken a particular interest in, and I'm going to discuss in a little bit more our two ethical funds that you may already be familiar with, our Global Sustainability Leaders ETF, ETHI, and our Australian Sustainability Leaders ETF, FAIR. But just before I go into the more granular details on each of those funds, I just wanted to expand a bit more on the demands that we're seeing in our own experience at BetaShares with ethical investing in Australia more broadly. And I think it's because the topic of ethical investing is a conversation that's definitely being had across a wider cross-section of people than I think we even anticipated when we developed the funds. We're seeing the media conversation become more broad and definitely more robust. We're seeing researchers like Nathan really drive the investing with impact message across their firms. And I don't know, personally, in my world, speaking directly with advisors from the ground level, that we're seeing demand from just a really broad range of advisors who may not previously have considered an ethical investment solution, but they may have a handful of clients who have instructed them, or that they know would like to avoid investing in certain stocks or sectors, or would just prefer to invest with certain considerations in mind. And this is why I think ETHI and FAIR have really been so strong, is that when we developed these funds, we did it with the ideal of being able to provide an investment solution that was relevant to the broadest cross-section of ethical or responsible investors. And we did this by creating a fund that we felt had the strictest exclusions from a negative screening standpoint that was currently available in the Australian market, but also one which positively promoted companies that engaged in socially responsible activities or governance practices, and that were making a positive impact, particularly with respect to environmental concerns. So for us, it was about creating a true to label investment fund, and that concept of being true to label really drove every aspect of the way that the funds were developed, and the way that they operate. Now, each fund does have a different way that it screens, because they do operate in different investment universes, one being global, one being Australian, and we'll go through those next. But the real key feature of our ethical funds, which we believe is absolutely critical to their efficacy as ethical funds, and which definitely doesn't exist in similar funds, is the existence of the Responsible Investment Committee, and the role that committee plays in overseeing the final makeup of the index. Because the idea of ethical investing, it doesn't exist in a vacuum. There is a lot of factors and considerations which are constantly evolving over time, to the point where you are left with quite a large grey area, and that's a grey area that we definitely believe requires some form of human oversight to ensure that these funds will always remain true to label, as we said, and that they will continue to do so over time as the considerations which really matter to the investment base grow and they change. In simplest terms, we've got to put there that the committee oversight is critical to ensuring the portfolio remains current. And I mean, I'll just use an example of if you were to have an ethical investment fund in, say, the 70s, well, armaments may have been a relevant consideration then, but tobacco as a public health problem wasn't particularly relevant. And I think that's very similar now with what we're seeing in data. Individual data, protection of that data is becoming more and more relevant to businesses, and it's becoming more and more relevant as an ethical consideration. And I'm sure many of you may have read that recently the Responsible Investment Committee, in part of their oversight role, made the decision to exclude Facebook from the index, following ongoing, I guess, controversies about the company's management of personal information, personal data, whether that management was responsible, and the way that they gave access to that data to third-party companies. We ultimately believe that there was a high risk that Facebook would continue to be the subject of ethical controversies, purely on the back of that they did have a pattern of being reactive to serious issues, and to only take those issues seriously once they reached significant public attention. So for us, the Facebook controversy is just a way that highlighted the role of the Responsible Investment Committee, and how that will allow the fund to continue to evolve over time and remain current. So I'll probably now just more go into, a bit more detail about each fund and their screening methodologies. And we'll start with ETHI. So ETHI is our Global Sustainability Leaders ETF. It's effectively a global 100 fund. It gives you exposure to the largest 100 global stocks, which we consider as climate leaders, and which, as it says there, are not materially engaged in activities that are deemed inconsistent with responsible investment considerations. And the way this fund operates and the way we come about with our final 100 index constituents is we basically start with a large cap universe of about 6,500 stocks. We screen them for minimum market cap and liquidity requirements. We then screen for climate leaders. And what that means is that companies have to have a direct carbon impact at least 60% below their industry average. And we get this data from Trucost, or an S&P Dow Jones company. And I think a good example of that is Apple. Apple is very much a climate leader in their industry. They announced a goal in 2016 to have zero carbon footprint across their supply chain by the end of 2018, and recently, as a couple of days ago, just announced that they'd reached that target. And they now have no carbon footprint. We then look we then run our negative screens. And for us, we think these are, as I mentioned before, the strictest that are available in the market. So these are screening for things like fossil fuel, gambling, tobacco, armaments, there's an alcohol, pornography, etc. We can get the full list available on the website, and we do also have a slide up there of it. And just in terms of exposure limits, so the other critical thing with developing these indexes is definitely diversification. So with these, we do have a maximum weight of 4% to any one stock, and also a minimum weight of 0.5%, just to ensure that every stock is relevant to the index. So over here, we just have a bit of a outline of our exposure limit guidelines. Importantly, with both, we do have a fossil fuel lending, which comes under indirect exposure to fossil fuels, so it's no more than 5% can be available for financing of fossil fuel activities. And I think Nathan really highlighted it, is what you get with these kind of funds. You're definitely not sacrificing performance for investing responsibly. And so if we go on to the next chart, you can actually see the index performance, and that's less MER relative to the MSCI World in Australian dollar terms. And you can see that, over this period, we have demonstrated outperformance. You can see on the next page of the ETHI's index versus MSCI World and Global 100 that it has performed exceptionally strongly over recent years. The only year where you saw notable difference in performance was in 2016, where there was obviously a rally in materials globally. But I think for Australian investors, particularly with ETHI, is through these screens, you are actually getting exposure to a number of sectors and a number of companies that you don't necessarily get a natural exposure to in Australia. So even as an Australian investor investing offshore, you do get a lot of diversification benefits just by investing ethically. So I will move on just to FAIR briefly. So FAIR does screen in a very similar way to ETHI, but as I mentioned before, each operate in a different market, and the Australian market itself is quite different and unique relative to the global market more broadly. So we do start with liquidity screens here. It effectively works out to around the ASX 300 there by the time we make those minimum market cap and liquidity requirements. We then remove companies directly or materially involved with the fossil fuel industry. So probably just as importantly with FAIR in the screening methodology is fossil fuel financing, which particularly in Australia means that this fund does not have any of the big four banks in it. As an example of one that is included on the basis of that screen is actually Bendigo Bank. So Bendigo Bank is part of the index, and that's because a number of years ago it became one of the first Australian banks to actually rule out lending to fossil fuel projects. So I think that's particularly relevant as a consideration here in Australia. We then, once we've done those negative screens, we apply a screen for what we call sustainability leaders, and what that means is that they generate at more than 20% of their revenue derived from a number of sources. It could be that renewable energy, waste remediation, animal health, food and nutrition. They're all listed there. But that is then a second layer of positive screening that we put in to really try and promote those companies in the index that are making a positive impact on society. So I think just as some unique screens with FAIR, it's probably worth highlighting that we do have a payday lending screen. Things like cash converters would be excluded, and particularly something with the controversies that we've seen recently with Afterpay and lending to miners essentially. Now, while Afterpay hasn't quite made it into the index yet, due to their lending practices, probably wouldn't make it into the FAIR index. The other screen is we do have what we call a unique gender diversity screen, and what that means is that we do exclude any company that would otherwise make the index that has all male boards. And I think just as a holdings comparison, which is on the next slide, again we have screens in place to ensure diversification. So we still have a max weight of 4% with this. We also only allow a maximum of 10 stocks from any particular sector. So that means that you aren't going to end up with a portfolio that is dominated by healthcare companies. You're not going to end up with 20% CSL. We have a very diversified portfolio here, which when we talk about the performance argument has actually left seen FAIR outperform the broader ASX 200 over the back testing period there. We think the companies that you're holding in this index in a diversified way do still hold strong growth prospects going forward. Lastly, I just think as a highlight on the holding comparisons there, it's just back previously. As I mentioned, for us, true to label will always continue to drive what we do here. And just what has been offered previously over the Australian market in particular, we just genuinely don't believe has been true to label. I think, Nathan, you'd definitely resonate with those comments. I mean, if we do have a look at one particular screen there, it is an ethical fund, but its only screen is for armaments. And being that there's actually no armaments companies in the ASX 200, you effectively end up with the ASX 200. So that's in terms of specific fund level and the way these funds operate, those are the key points that I wanted to go over. I think, Alan, that you've got a few questions here that we can now take some time to answer.
Yep, that's right. And also, I'll just before I do that, I'll just point out there are obviously risk factors associated with any investment. I put those on the screen. One important thing to realise is that both these funds are equities funds. So that does mean they're going to be exposed to the equities market. So there's no way to proof against that in a sort of broad market ethical fund like the ones we have here. So it will be exposed to the rises and falls of the Australian share market, and in the case of ETHI, the global share market. So yeah, I will go to some questions. We've had quite a few questions come through for both Adam and Nathan. I'll also just point out that in relation to the two funds that have been mentioned today, there is a handout section in the widget which has the information on those particular funds. Of course, you can request those from us afterwards. And I will also mention that everybody who is on this particular webinar will receive a copy of the presentation itself, as well as a recording of the audio. But in terms of some questions here, there have been a few, so I'll just pick out a few of those.
Ilan, just as a sort of an opening comment
Yes.
before we dive into the questions, I think just looking at some of the things that I've seen coming up on the screen, one of the key things I just want to remind everybody is that it's not Morgan Stanley's or anybody's view that we are trying to be the arbiter of morality. We're not trying to stand here and tell you that this way of investing is better or that way is more ethical. The key message that we're trying to get across here is that you need to be transparent. You need to actually see what the underlying holdings are. And I think there's a question up there right now that's asking about A2 milk. You know what? That's a very valid point on whether or not the treatment of animals in such a fashion is ethical. But that is not a question for me or for Morgan Stanley or for any firm to decide. That is something that you as an investor need to decide. But to make that decision, we need to make it as easy as and accessible for you to get that information, which is why things like BetaShares, ETFs, where they do disclose all their holdings, and in fact, any of the fund managers that participate on Morgan Stanley's Investing with Impact platform are also required to do this. They need to disclose all their holdings such that we can actually verify what they say is what they do.
All right, great. So, do you think look, this is just a question I suppose to you, Nathan. Do you think the Australian government policy that leans towards coal has or will have an adverse impact on ethical investment?
You know, that's a really good question, but I think the interesting thing is that if you actually take a step back and if you look at the FUM numbers in terms of how responsible investing has grown in this country, we've sort of endured very uncertain energy policy for many years now. But despite that, responsible investing continues to grow and grow. And I think the key message here is that capital will always find its way. Even if you put roadblocks up one way or another, capital will go where it needs to, where it can find its efficient use. And the best example I can think of that on a practical level is just look at the success that solar and solar rooftops have experienced in this country. As a nation, we have one of the highest per capita installation rates of solar anywhere in the world, and that's despite the fact that the policy environment for renewables has been chopping and changing for some time, and that clearly shows to us that if you allow capital to allow the market mechanisms to allow capital to be efficiently deployed, people like many people in Australia have figured out that when you install solar on your roof, you can get a payback of between 5 to 6 years on that investment. Why wouldn't you be doing that?
Excellent. Look, there's just a comment here around semantics and the use of the words, and I think it's a reasonable one, just about, you know, as Nathan said, there are a lot of different terms flying around this industry, and the comment here from Shane is that the use of the word ethical investment, you know, is a term that, you know, shouldn't necessarily be used, and in fact, we should possibly use, or the suggestion from Shane is that to use the word responsible investment as an umbrella term for ethical, socially responsible impact investing. And I'd just love to hear your thoughts on that, Nathan.
Oh, 100%. I would completely agree with it. I think we're very big supporters of the work done by RIA, the Responsible Investment Association of Australasia, starting with a capital RI. I think that goes a long way as the correct umbrella term. The responsible investing principles, again, capture a multifaceted approach. And again, it really comes back to that investing with one's values really speaks to things that are quite personal. And what is okay for one is not necessarily okay for another. And so I think that comment by that individual is very valid, and I would wholeheartedly agree that the use of terms needs to be some way standardized, and I would definitely rally around the approach pioneered by RIA.
Absolutely. Okay, Alan, maybe a question for you, and I think I'll take the viewers back to a previous slide that perhaps you didn't go through in any great detail, but there's a question here about what are the differences between ETHI and fair and other ethical or responsible investment products available in Australia. I'll just try to find that. This is the slide that we sort of flew through, but just any broad comments on that, Adam, from your perspective?
The difference between ETHI and fair and just the other broad.
Yeah, so the other ethical.
The other ethical. So yeah, definitely in terms of from a negative exclusion standpoint, which is our fossil fuel lending criteria, we definitely feel they are the strictest. So you can have a look at sort of a comparison of ETFs there. Now, we haven't really, well, definitely for out of respect, we haven't named any names there. They're under ETF 1 and 2, but you can see that financing fossil fuel producers is a big one for us. We exclude the big four banks on the back of this, as I mentioned before. Coal-fired power plants isn't excluded by another. You can then see things like, gas pipelines have been included in some other ETFs. So particularly on the fossil fuel and the environmental side, we definitely feel we are the strongest there. In terms of global ETFs, there's animal testing for cosmetics. We screen that out, but that's been largely ignored by other ETFs there. So, and I think it still comes back to us is the big different feature beyond going, these are our negative exclusions, those are their negative exclusions, really comes down, as I mentioned, to highlighting the role of the Responsible Investment Committee. That element of human oversight, I don't think can be overstated. And we've really recently seen the effect of that with the ability to take a look at, what the controversies of Facebook, whether they are responding to those appropriately, whether we believe they will continue to be able to be considered a responsible investment, and being able to remove them accordingly on a short turnaround.
All right, here's a good question here from Stephen, who is interested in keeping his finger on the pulse on ESG-related investment issues. So a question for either Nathan or Adam, what are your top or favourite sources of information that you have relied on over time to keep yourself up to date? Definitely a good one for Nathan, I think.
I can tell you that we have a partnership with MSCI ESG Research. They are one of our preferred research providers in the U.S. and here in Australia. If you can gain access to their service. Now, admittedly, that is very much behind a paywall, and you would need to pay to gain access to much of their research. The other thing I think that is quite important is just to stay well read. I make it a point every day. I read 3 newspapers every morning. I don't know if everybody else does that, but I read the Financial Times, the Wall Street Journal, and the AFR just to sort of get a flavor of what's going on in the world. And for me, that more than anything else helps me sort of stay abreast on what's going on in the world.
Excellent. Now, there's a couple of questions here on a few specific stocks. I'm not sure whether if anyone wants to talk about that, but there's a question here about how we actually get the weightings in the portfolio in relation to ETHI and fair. And maybe you can just describe how we actually end up with those final weightings once we've done the exclusion.
Yeah, so we do have filters for market cap and liquidity, but we weight the stocks by market cap. With fair, we take 10 stocks from each sector, the largest stocks, and then we filter them for market cap, and then we put obviously the maximum weighting of 4% in each. It's the same with ETHI, but we don't necessarily need that the same sector filter there. So we take the largest 100 stocks by market cap, but then we obviously have those market cap constraints of 4% for each individual stock.
So there's a question here, and we'll just probably have time for a couple more questions. There's a question here about the Facebook removal and whether that makes BetaShares an active fund.
Yeah, definitely. I think you're referring to an AFR article there that I think the title was BetaShares allowed to dump Facebook from its passive ETF. It's definitely, ETHI and fair are passive funds in that they do not make subjective stock picks based on company fundamentals. That is what an active manager does. That is, when you're paying an active manager, you're paying an active manager to make those stock picks for you. The only active element, which we wouldn't consider an active element, is the element of human oversight, which allows us to remove companies when we believe that there's been a material change to their business, or whether the Responsible Investment Committee believes that they can no longer be in the index based on the considerations that they need to make.
Okay. And Nathan, there's a question here broadly about our use of the gender diversity screen, and you know, how that ties into, I guess, the question of either political correctness or actual responsible investing. I guess is the broad question. How would you respond to that topic?
I think quite simply, I'm always a big fan of evidence-based investing, and I think clearly that there's a multitude and an avalanche of studies out there that show that a more balanced board results in better outcomes. This has got nothing to do with responsible investing. This is actually, if you want to be a pure capitalist, actually in the best interest of the company to get a diverse range of views. So I would disagree with that assertion that we're being politically correct. I think we are being economically assertive.
Excellent. So I think we probably just have one last question here. And I think that is about, well, it's a broad question once again for you, Nathan, and I guess it's a pretty easy one for you to answer. Has Morgan Stanley seen an increase in client demand for ethical investment solutions?
You know, that's a really interesting question, and the way I would answer it is that no, we haven't seen an increase in demand. What we have seen, actually, is that it's always been there. The demand has always been sitting there completely unmet, and that's the way I would sort of phrase it, that there are many of our clients that over the years have simply given up trying to find solutions to meet their values, as we've seen time and time again, unfortunately, over the last many years, where you've seen many firms come out with what I call light green or greenwash products that really did the industry a disservice by being not necessarily genuine with their approach. And as a result of that demand for responsible investing products sort of went to sleep. And I think what's happened now is that there's been a reawakening and people are just realizing that they can make that choice. So I wouldn't call it growth as opposed to simply unmet demand.
Excellent. Well, look, thank you very much all for your attendance. Thank you, Adam. Thank you, Nathan, for the comments. We do have information, obviously. There also will be a short survey that will be popping up on your screen post the closure of this webinar. We thank you all very much for your attendance, and we look forward to being with you again shortly for further BetaShares webinars. Thanks very much, everyone, and goodbye.